Hi everyone. In this video, I wanted to highlight one Cathie Wood owned growth stock that I think you might regret not buying since it's down 70% off its highs. Now, me and Cathie Wood, we don't typically agree on very many investments. She's more of an innovative growth stock investor. She's willing to pay premium prices for growth stocks, whereas I don't mind buying growth stocks. I don't mind innovative growth stocks, but I typically don't like the valuations that are attached to some of these innovative stocks. But this one, me and Cathie Wood agree on. I think it's a good value. Cathie Wood owns a good deal of this stock. So before I reveal what this growth stock is, I'm going to highlight some of its financial metrics, and then towards the end of the video, I'll highlight what the growth stock is. So let's get right into it here, starting with revenue growth. And you can see this company has grown very nicely. Since 2020, revenue was less than 200 million. It's now more than tripled to 600 and 55 million in revenue in its most recent quarter. Phenomenal growth, and it looks like trends are in this company's favor. It is offering a platform that is mobile games. You can call it mobile games. You can call it metaverse. It's both of them combined, and the industry is working in its favor. It was a pandemic beneficiary. Some worried that when economies reopened, this company would struggle. But as you could see, it did experience a slight dip in 2022 when economic reopening gained momentum. But then it rebounded and re-accelerated, and growth really took off even after those slight temporary headwinds from the economic reopening. So that was impressive to me, to be sure. And interestingly, the company generates very strong cash flow from operations to sales. This means it's turning sales into cash flow from operations effectively. Now, this is down considerably. This is the metric that was hurt the most because of the pandemic, because of the reopening, I should say, where before, when people were stuck at home and entertainment options were more limited, this company had cash flow from operations close to 50% or above 50%. That's now come down to around 16.5% over the last several few quarters in the trailing 12-month update. This is where I think the company's cash flow from operations will likely be around equilibrium for the next several quarters until it ramps up. It's got a new revenue and cash flow engine that it's ramping up. I'll talk about that a little bit later, but until it gets that ramped up, I expect it to be in the double digits, which is solid for a company that's growing this nicely. I'm okay with this cash flow from operations staying around here until it really ramps up that new growth engine. So finally, I wanted to show you the valuation, and this is one of the few stocks that I'm willing to value on a forward price to sales ratio. Typically, I like to look at companies that are generating cash flow and generating profits. I'll look at the price to earnings or price to free cash flow. But this company is unique in that I'll look at the price to sales forward, and I'll tell you why after I reveal the stock. But first, let's look at the valuation. Forward price to sales of 6.258, near the cheapest it's been in about 2 years. Near the cheapest. There was moments where it was cheaper, but near the cheapest it's been. But I'd rather have it a little bit more expensive, but buying it now versus buying it around 2022 when its growth prospects were more shaky, right? If I go back to this chart here, revenue, look at around here in 2020. The growth was choppy, and investors, we still were concerned where growth would go for this company. Would it give up all of that revenue it gained during the pandemic and crash really low? Where was this going to be? Or was it a temporary downturn in an overall uptrend, right? So there was a lot more risk incorporated into this stock in 2022. Yes, the stock was cheaper, but I'd rather buy it now, a little bit more expensive, but with a lot less risk. With a lot less risk. So I prefer that. I prefer paying a little bit higher price if I'm going to be taking a lot lower risk. So that's the case here. So what's the company? The company is Roblox. Roblox, the metaverse Pioneer is the company I'm talking about, is the Cathie Wood owned growth stock that I'm talking about, that I think you might regret not buying on this dip here. And down 70% I think is a good value for this stock. And the thing I was talking about earlier that I said I'll talk more about later is the interesting thing about the company's revenue, right? When people put money on the platform, the company does not recognize it as revenue just yet. It recognizes the revenue over the next 24-month period. So for that reason, the company's revenue and cash flow and profits are a little bit discombobulating, a little bit hard to read and measure because of the way it accounts for those customer deposits that then turn into revenue over 24 months. Now, I don't want to get into all the wonkiness of that, but that's the reason why I'm willing to look at this stock on the forward price to sales ratio. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.